Hi, it's Lee and welcome to Tesla Economist. So proceeding on from our last video in trying to estimate what Tesla's margins will be at various price points and to predict what earnings will be in 2023, we went through all the financials over the last 2 years and picked the 2 quarters that had the least noise involved in the financials, i.e. minimal factories ramping, lockdowns, etc. At these times, there were still severe supply chain issues, but that is hard to quantify. But we can just keep it in mind that potentially the costs were higher as a result of that increased pressure. We know that shipping costs were definitely much higher then, although oil prices were also slightly lower then too. Anyway, we'll use the numbers that we have at our disposal to do our best. The quarters that had the least noise were Q3 2021 and Q4 2021. Incidentally, around the time Tesla's stock was the highest, which makes you wonder, is this what the company is like when it's firing on all 4 cylinders? When we see its true value and the new factories are creating so much noise? Just a thought. For those quarters, I've gone through and worked out what the selling price for the vehicles were at the time. With that, we can use the margins that we have at the time to try and work out how much these vehicles may cost to build. Now, admittedly, in this scenario, we are estimating margins for all the same vehicles, but hopefully it should average out enough in the long run for us, even if the margins are somewhat off from each factory. So I looked at all the prices of the cars back then when they were ordered, and bear in mind that these are just the base prices that we're using without people ordering any upgrades like paint, wheels or trims. The US prices are the Model Y long range at $51,500 to $54,000, the Model 3 rear-wheel drive at $38,500 to $39,900, the Model 3 long range at $47,500 to $50,000. Then from China, the Model 3 rear-wheel drive was 276,000 yuan, and the Model 3 rear-wheel drive is 236,000. However, these prices included the subsidies, which at the time I believe were 11,000 and 15,000. So the prices excluding the subsidies are 292,000 for the Y and 252,000 for the 3. We have to take the prices without the subsidies for calculating the costs with the margins. I have created the cost of goods sold for each model from each factory using these margins we saw in Q3 and Q4 2021. This gives us an estimated cost of goods sold per vehicle for each quarter. Although the margin was better in Q4, the prices were also higher, meaning the cost of goods sold were actually higher. I'd like to run with Q4's higher costs just to err on the side of caution. On top of that, I'm then going to add on to all these costs an additional 5% to adjust for inflation for the same reason. Just remember, Tesla have done many things since then that actually reduce the cost of the vehicles, removing parts and processes, and also ramped up to higher rates. So I truly hope I am allowing enough room in here for costs. Then on top of that, if the economy is as bad as we were doing in this analysis, we would expect costs down elsewhere too. Now we need to gather all the current prices. However, when we include the Chinese prices, we will have to use the price after the subsidy, as we can't depend on that subsidy. And we're trying to judge demand based on prices. And we're trying to judge demand based on the prices that the consumer is paying, not on what Tesla are selling them for. Also, bear in mind that these are the China prices. Tesla sell these same vehicles for a lot more with their exports. So there's a chance these prices are higher. On top of that, many of these export markets also offer subsidies. From there, we can see how much we estimate Tesla's margins to be for each vehicle, currently from each factory. As we can see, the Model Y long range in the US gets around 40% margin. This might seem high, but we have to remember they've raised the price by $18,000 due to it being so popular in order to control demand. This is a massive price increase. The US is also hitting 37% margin with the rear-wheel drive Model 3. Also, factor in that for the Model 3 margin we took, this was before Tesla moved over to LFP cells in the standard range, which might imply that costs did actually reduce somewhat with the lower cost cells, likely somewhere between $1,000 and $2,000. And we did also see a $10,000 price increase with that Model 2. Also, remember, these are all base prices. Not everyone buys a base Tesla. Then on to Shanghai. Now, bear in mind, we've already seen a price drop in the market, but if we remove the subsidies they're also receiving, then we get the Model Y at 25% margin and the Model 3 at 30% margin. Now we can add in all the margins and see what the new prices will be and compare them to the current prices, i.e. by how much the price of the vehicles drop to reach these new price points with the different margins. And that is what we're trying to establish. what prices each Tesla model would cost when we adjust the gross margin. From there, we can compare what other cars cost at that price and see how realistic demand will continue to be. Remember, we're also expecting demand to increase. Although all this increased demand that Elon is expecting can only really come from the Model Y long range, as these are the new factories that will be ramping, whereas the others are pretty much at full capacity. Fortunately, the Model Y long range does happen to have the highest margin, and we hope that from these new factories, they'll eventually cost less to produce once ramped up. So bear all that in mind, that Elon says he's going to reduce prices to generate more demand for the growth in supply, but we don't expect any more growth from Shanghai, so they only need to reduce prices there to maintain demand. These are already their lowest cost models too. Also, remember, we are just talking about price drops in Shanghai. The export markets already have much higher prices, and Tesla can export about 2/3 of the production there, assuming that there is perhaps more buffer there with margin. But we will include them with price drops as well. Tesla's been offering discounts and incentives in these other markets too this month to clear out inventory, but some markets have seen no incentives. Now let's take a look at these margins. If Tesla were to reduce at a 25% gross margin, then the Model Y in the US would now be $53,000 without any credits, which is a 19% price reduction. The Model 3 standard range would now be under $40,000, which is a 16% price reduction. As for Shanghai, the Model Y would be at the current price, and the Model 3 a 6% price drop. If Tesla are operating at a 20% margin, then that's a 24% price drop in the US for the Model Y, and a 21% price drop for Model 3 now at $37,000. A 6% price drop for the Model Y in Shanghai and 12% for the Model 3. At 15% margin, we now have a Model Y at $47,000 and a Model 3 under $35,000. Model 3 in Shanghai down 12% and 17% from the Model Y. Then, with a 10% price reduction, we have a Model Y under $45,000 and a Model 3 under $33,000, and a 17% price drop for the Model 3 and a 22% drop for the Model Y. Looking at these prices, I think we do have COGS too high, considering Tesla used to sell the Model Y long range for $48,000 in the US, even still in December 2019. We have them at a 15% margin at the same price, and we would have expected them to be getting perhaps at least 25% margin back then. That is a big difference. However, we will run with these COGS for now and see what numbers we get. Now, Elon said he is prepared to reduce prices further in order to actually increase demand, not just keep it stable. But this is not across the board. This is only for the models and markets that are actually going to be experiencing increases in supply. China is not one of those markets. In fact, the opposite. Tesla can export more vehicles out of China if they so choose. The Model 3 in all markets would not need to increase demand, but just maintain it, as all Model 3 lines are at capacity, unless they increase the capacity by upgrading to the Model 3 Highland, which would also increase demand and reduce cost. The only markets and models where Tesla need to increase demand are going to be the Model Y long range in Europe and Texas as they ramp. Now, none of those prices that I included in the US factor in the tax credit either. It would appear there is still a lot of buffer with the US market, and the tax credit will add to that extensively. If Tesla were at 20% margin for a Model 3 and we remove the tax credit, then it costs less than $30,000. Also, in case you were wondering, at 20% margin in China, the Model 3 would be $32,750 and the Model Y $38,000. Remember, this is the export hub, so add tariffs and shipping on that, and then think about what prices you would expect them to be internationally. In the next video, we'll add these COGS and margins into the financials and play around with various permutations of what we think might be likely and see what earnings figures we get. Also, comment on where you think it likely Tesla's price points may need to be in order to maintain the demand, and let me know what you think of my estimates for cost of goods sold. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.